In early 2025, a GitHub repository started going viral. It was called AI Hedge Fund. The pitch was simple and genuinely exciting. An artificial intelligence system that could research stocks, debate the investment thesis, and tell you whether to buy, sell, or hold for free. Open source, no subscription. Within weeks, it had accumulated over 70,000 stars on GitHub. That is more than most legitimate, widely used software tools. People were posting about it on Reddit, Twitter, LinkedIn. Finance forums were on fire. The headline was impossible to ignore. What if AI could finally beat the market for regular people? I spent a week taking it apart, and what I found might surprise you. To understand why this went viral, you have to understand the promise. The project was not just one AI model making trading calls. It simulated an entire analyst team. Think about how a real investment bank works. There is a research analyst, a risk manager, a portfolio manager. Each one brings a different lens to every decision. The AI hedge fund attempted to recreate that structure digitally. One agent, the bull, was tasked with building the strongest possible case for buying a given stock. A second agent, the bear, was tasked with tearing that case apart. A third agent read both arguments and rendered a verdict: buy, sell, or hold. The backtesting charts that appeared in the README showed returns of over 200% across a 4-year period. For comparison, the S&P 500 returned roughly 70% over the same window. These numbers spread everywhere, and for anyone who has ever wanted a piece of algorithmic trading, which used to require a quantitative finance degree and a server farm, this felt like a door had finally opened. So I cloned the repository and ran it. Here is the mechanical reality of what happens. You provide a stock ticker. Let us say Apple, AAPL. The system fetches publicly available financial data, price history, some basic fundamentals. Then it constructs 3 separate prompts and sends them to a language model. Prompt 1 reads something like, "You are a bullish equity analyst. Based on the following data, make the strongest possible case for buying this stock." Prompt 2 reads, "You are a bearish analyst. Using the same data, argue the case for selling." Prompt 3 then says, "Here are both arguments. Based on this debate, what is your final recommendation and why?" The model, in this case it was configured to use either Claude or GPT, depending on what API key you provided, returns a text recommendation: buy, sell, or hold, with a brief rationale. That output is what drives the backtesting engine. And that is it. There is no live brokerage connection. No actual trades are placed. No real capital is at risk. It is, at its core, a prompt chain with a financial data API bolted on, which, as I said, is genuinely interesting as a research exercise. But it is not a hedge fund, and the distinction matters enormously. Here is where I want to slow down, because this is the part that trips up a lot of intelligent people. Every quantitative trader knows about the backtesting trap. Running a strategy against historical data and seeing good results is not evidence that it will work going forward. It is evidence that it fit that particular slice of history. There is a phenomenon called look-ahead bias. In a backtesting environment, the AI knows what actually happened. It knows that Apple ran up in 2023. It knows that tech sold off in 2022. That knowledge, even implicitly baked into the training data of the language models, creates a massive advantage that will never exist in live trading. There is also a related problem called curve fitting. When you test a strategy across thousands of parameter combinations and show only the best result, you are not discovering a strategy. You are discovering the settings that happen to fit that specific historical data set. Change the start date by 6 months, and many of these systems look dramatically different. Now, I want to be clear. I am not saying the developers were being dishonest. I believe the project was created genuinely, as an experiment, and the authors have been transparent about its limitations. But the way it spread, the screenshots, the viral headlines, stripped out all that nuance. And perhaps most importantly, months after this repository reached 70,000 stars, there were zero published live trading results. No one had run it on a real brokerage account and posted their actual profit and loss statement. Not one. Because the moment real money is on the table, the edge disappears. None of this means that AI has no legitimate role in financial markets. It absolutely does. But the use cases that are working right now are fundamentally different from autonomous trading. First, earnings transcript analysis. A single quarterly earnings call can run to 40 or 50 pages of transcript. AI can scan that document in seconds, flag sentiment shifts, extract key guidance language, and compare it to previous quarters. That is genuinely useful. Humans doing the same thing takes hours. Second, news flow monitoring. Institutional traders pay thousands of dollars per month for services that aggregate and summarize financial news across hundreds of sources. A well-prompted language model can approximate that for near zero cost. Third, fundamental summarization. Taking 10 analyst reports on a single stock and getting a synthesized summary before the market opens, that is a real edge in research speed. Fourth, regulatory filing review. SEC filings, particularly the risk factor sections, are written to be deliberately opaque. AI is remarkably good at identifying unusual language or new disclosures buried in these documents. Fifth, portfolio stress testing narratives. Describing your current holdings to a language model and asking it to construct the worst-case macro scenario is a surprisingly useful exercise in risk awareness. These are the cases where AI provides genuine, measurable value. Not because it predicts the future, but because it processes, synthesizes, and surfaces information faster than any human can. It is worth zooming out for a moment. The most sophisticated quantitative hedge funds in the world, Two Sigma, Renaissance Technologies, D.E. Shaw, employ hundreds of PhD-level researchers. They have access to alternative data sets that most people have never heard of. Satellite imagery of retail car parks, credit card transaction aggregates, shipping container movements. And even they get it wrong. Consistently and spectacularly. The idea that a free, open-source prompt chain built over a weekend can replicate what these institutions spend billions developing is, at minimum, optimistic. That is not a knock on open source. Open source has changed the world. But the specific claim that this is a working hedge fund should be met with the same skepticism you would apply to any investment product promising extraordinary returns with no disclosed risk. So, here is where we land. AI Hedge Fund is a fascinating, well-intentioned project. It is a great way to learn about language model chaining, financial APIs, and backtesting frameworks. It is not a reliable system for deploying real capital. The lesson is not that AI cannot help investors. It absolutely can. The lesson is that knowing where the tool is genuinely useful and where it is not is the actual edge. In the next video, I will walk through 5 AI tools that financial analysts are actually using today in professional settings. Real use cases, real workflows, no viral hype. If that sounds useful, subscribe and hit the notification bell so you do not miss it. And drop a comment below. Have you used AI for investing research? What worked? What did not? I read every single one.